We have equity markets at record highs, a U.S. government shutdown that prevents the release of some crucial economic data. What about the bond market? Is it telling us anything we need to know? Any warning signs there? Joining us now to discuss is Scott Colborne, Managing Director and Head of Active Fixed Income Management with TD Asset Management. Scott, great to have you back on the show.
Yeah, good to be here, Greg.
From the look of stocks, you wouldn't think there's anything going wrong in the world whatsoever. Yeah. But we do have this shutdown. We did have a Jobs Friday that came and went without a jobs report. What's the impact here if we're not going to get this data?
Well, I think it adds to the theme. Like, there's lots of themes and narratives in 2025 in the market, and one of those themes this year has been uncertainty, right? And when you look at the lack of data and the jobs shutdown, it just sort of, it's a fog of uncertainty over the direction of the economy. The data that comes out of the U.S. government is top tier, and so we have to, as investors, you look to, other data to give you signals. And I would say, broadly speaking, one of the narratives and themes this year has been an economy that is modestly slowing down a bit at the margin, but more of a risk on the labor market side. And the second tier data that we've seen sort of supports that notion. A little softness on the service side last week, and we've seen some softness in the ADP numbers on the job side. So, you lean into that narrative, and you would expect that the Fed is going to sort of stick to its guns. It telegraphed that it's going to probably cut another 2 times through the balance of this year, and despite the lack of top tier data, we're probably in that direction.
How long does that second tier data take us? I mean, I've had other discussions with some of your colleagues on the equity side where you talk about the thing about a shutdown is ultimately it's the duration. If this gets drawn out for a long time, then maybe we start to see some problems. But right now, we're not too worried. Is that what's going on here? The second tier data will only take us so far?
I mean, the second tier data give us good indications, but it's as you say, it's the length of the shutdown and the implications of that. So do we get a lot of layoffs, right? We've got 100,000 people being laid off through early buyback as of October 1st. So, that in addition to the risk that if this protracted, shutdown happens, there may be further cuts on the labor market, and that only compounds the fact that, the risk is to the labor market side. And so, yeah, it's going to be a challenge, and it only takes you so far, but you sort of know where the risks are, and the skew is on that balance. And let's say the shutdown is on the opposite side. We're over and done in a week or so. You're basically going to see a substitution of, the slowdown in this month just get pushed out to the next month or the next month, depending. So it can work both ways.
Whether saying it's regional bank deal making, whether it's AI deal making that allows the equity market to say, we got something to focus on, don't have to worry about the shutdown. What about the bond market? Is the bond market giving us any signals right now of some trouble ahead?
So the themes and narratives, I'm going to run with this a bit, but one of the big themes this year is fiscal. When you look across the globe, including the U.S., it's the steepening of the yield curve, the pressure on the longer end of the yield curve. We had a little bit of noise over the weekend in Japan and France, and it's added pressure to the long end this morning in the bond market. And so that is one signal, right? Watching the fiscal side. Is it disorderly? No, but the pressure is on the bond market. The other issue is credit spreads are very tight, and we valuations sort of echoing what's going on in the equity market are fully valued. Is there any issues there? Well, we've seen very idiosyncratic issues there. There's been a couple of bankruptcies in the U.S., sort of highlighting some stress on the consumer side. Is it systematic? Is it a risk to the broader credit market? No, but it's that's another signal that's coming out of the credit market. And finally, I would say the theme of a weaker U.S. dollar plays out. It's not a bond market per se, but it's a outcome of the fact that the Fed is going to continue to ease short-term interest rates, and the U.S. dollar is sort of continues to soften. It's off about 6 or 7% this year, but the risk is it continues to weaken off.
So when you look at an environment like this where credit spreads are, that tight, we feel things are fully valued, whether we're talking about bonds or equities, are there any opportunities right now for anybody in the bond market?
Yeah, I mean, myself and my colleagues have been sort of hammering this home this year. The credit market continues to be good, right? I mean, all-in yields, steady bond market yields, government bond market yields, plus a risk premium that is, depending on where you are, 75 to 100 basis points higher than government yields, still give you a nice, attractive all-in yield, right? Yes, valuations are fully valued, but you hold them to maturity, and it's a good yield. So, you're talking about 4.5% to 5% in the U.S. You're talking maybe 3.5% to 4% in Canada. So it's not bad. Recognizing, yes, credit spreads on the tighter side, but it's still good, attractive credit. There are no, systematic risks to be worried about right now. The other one is the short-term yields are going to continue to go lower in the U.S. And I think that that is an opportunity, and yields will get pulled down a little bit in the U.S. So that is an opportunity. And finally, echoing the U.S. dollar story is emerging markets, local emerging market debt. Currencies like Mexico and Brazil and Colombia this year have done well, better than the Canadian dollar, better than the U.S. dollar, and buying some of that in some portfolios has been a nice addition this year.
So if someone's thinking about the fixed income space, are they still thinking in the traditional way? You're going to get your coupon, maybe you get a bit of price appreciation on the bond, make that a part of the portfolio construction.
Yes, absolutely. I think there are opportunities.